we're as optimistic about Bitcoin as we ever have been. But there are a few regulatory and tax uncertainties, and we had been waiting for the discount between GBTC and NAV to narrow. It was as high as 50% at one point last year when there was great uncertainty around all of the turmoil in crypto generally, and now it's single digit. And there are now other products out there that we can use to gain exposure to Bitcoin in this moment. And it's just a moment of uncertainty between now, we think, and January 8th to 10th, somewhere in that range, perhaps. But we, out of an abundance of caution, didn't want to take any risk. BITO, the ProShares, is already approved. There's no regulatory uncertainty having to do with it. So we chose to maintain our exposure through BITO for the time being. And as I mentioned before, there are some tax and regulatory uncertainties still as part of this process. We don't know exactly who's going to be approved and whether they've met all the criteria that the SEC has put before us. We know we have, but we don't know if others, including GBTC, have. We just don't know. So again, out of an abundance of caution, and GBT's discount, again, it was as much as 50% relative to NAV. So not only have we enjoyed this year the run in Bitcoin itself, but we've had the nice closing of that discount. So it's been double good news for us. We think the probabilities have gone up because the SEC has been highly engaged compared to what was happening before. Before, it was just denying approval. And we just kept putting our filing in again, try, dogged and determined. And so here we are. We think we're first in line, and that's why there is this January 10th deadline. But we like the idea that the SEC has been so engaged, and it's not just with us; it's others as well. We think a number of funds could be approved at the same time. And they've been asking not only one set of questions, but follow-up questions. And again, that's a very good sign. It's not 100% certain. And so we want to make that clear as well. This is the SEC, and we never know, what might happen along the way.
Hey, money talkers, if you've been riding the Bitcoin roller coaster, things just got wild. Buckle up, hit that like button, and let's talk about the queen of innovation herself, Cathie Wood. Today, we're diving into Bitcoin's price drop, miners making moves, and a whopping $10.1 billion showdown. Let's begin. Cathie Wood, CEO of Ark Investment Management, foresees widespread institutional involvement in spot Bitcoin exchange-traded funds, ETFs, following anticipated approval by the U.S. Securities and Exchange Commission, SEC. All we need is for the trillions of dollars in institutional assets out there to allocate maybe 0.1% or 0.2% to an ETF, which will be one of the easiest ways to gain exposure and one of the most efficient ways to gain exposure to Bitcoin, she explained, adding, that will move the price significantly. Bitcoin's on a bit of a roller coaster lately, and everyone's wondering why. Rumors, speculations, and surprises, it's all in the mix. Renowned analyst Ali Martinez dropped a bomb on X, revealing that miners unloaded a hefty 3,000 BTC, totaling a whopping $129 million. What's the miners' game plan, and how's it impacting Bitcoin's wild ride? The crypto universe is buzzing with chatter about miners playing the sell-off card. Ali Martinez's chart has thumbs wagging, hinting at a potential game changer. With Bitcoin's recent rally, miners cashing out adds a layer of complexity to the market dance. Are we in for a short-term shakeup, or is this just a plot twist in the larger crypto saga? But wait, there's more. December 29th is not just any day. It's the $10.1 billion options expiry showdown. Deribit and CME are flexing their muscles with a colossal $9 billion combined interest. Bulls and bears are gearing up for a fierce battle, and the SEC just tossed a curveball. They're setting a deadline for spot Bitcoin ETH amendments, adding a spicy twist to the crypto plot. The stakes are high, and the countdown begins. The SEC, Bitcoin ETFs, and a potential reshaping of the crypto landscape. The buzz around a spot Bitcoin ETF in January is sending shockwaves. The SEC's changing tune, moving from rejections to friendly chats, has the market buzzing with optimism. Will the ETF dreams come true, or is it just another tease? Binance's dance with the US DOJ and Grayscale's ETF application, it's all in the mix. Hold on to your crypto hats, the climax is near. Now let's continue our discussion with Cathie Wood.
We are very happy that a couple of things have happened. That this idea that interest rates were going to continue moving higher has been proven incorrect. And I think even the Fed, while there is that small possibility, even the Fed is now starting to talk about the other side of the interest rate move. And so I do believe all we've seen so far is a reaction to that macro phenomenon or judgment call. We went through our flagship strategy, and all of our strategies went through a very difficult time from February 21 through December of 22, as interest rates, first of all, were presumed to move up or forecasted to move up. And then when they did move up, so it was almost like a double discounting. Mm-hmm. And so we've seen the first installment of the correction there to the upside for our funds with this notion, and it's again the forecast that interest rates will come down. And we would presume that if they do come down, for the reasons we think they're going to come down, the most important one being deflation, then our funds will be in good shape, because we are our companies thrive on deflation. Technologically enabled innovation is deflationary. We put up a chart in one of our in the nose, which is a YouTube video that I do every month, Employment Friday. And in that chart, you will find a ratio. It's the metals to gold ratio. So metals price to gold price. And there has been an extremely tight correlation between that ratio and long-term interest rates. In October, we published it, or early November. Mm-hmm. And what you will see is that there was a very wide gap that had developed. The metals to gold ratio was near its low for the past 12, 15 years. And interest rates were at their highs, 5%. The correlation, if you just eyeballed that chart, the correlation suggested that rates should go to 2%. Now, maybe they won't go all the way to 2%, but we think that long-term interest rates are way above where they're going to end up because of deflation. We were very gratified at our asset retention in 21 and 22. In fact, we had net inflows, if you combine both years, of more than $18 billion. And this year, one might expect that those who average down into the very steep declines that we were seeing in 22 especially, might take some profits. So we have had, I know for our flagship strategy, it's roughly $500 million in outflows, maybe for all of our strategies, 1.8 million. So maybe 10% of the inflows that we enjoyed during 21 and 22. So again, we're very gratified and grateful to our clients for the support that we continue to receive. We have had days of, on balance, very recently, yes. And I think part of this is many people do tax management toward the end of the year. And so some of the outflows might have been associated with clients who got in at a high cost base and were just harvesting some tax losses. But I think we're through that.
Do you find it a little surprising, though, Cathie, considering the run-up? Or I'm curious about the conversations you do have with investors, considering the year that you're having, and then to see those flows. It's got to be a little disheartening. Yeah.
Oh, no, not at all. Actually, we put out a piece for Resolute, our distributor, who, and we basically showed to them, if you rebalance our strategy when there have been big moves one way or the other, if you rebalance regularly or based on a rule like when the fund's up 15% relative to everything else, take some profits. And what that study showed that if you are disciplined that way, that over any rolling 5-year period, it is highly likely, almost 100%. I'm not quite sure if it's quite that high, but that you will beat the market, meaning as measured by the NASDAQ or the S&P, over a rolling 5-year period. And so a lot of our funds are with advisors who are very sophisticated and responded somewhat, perhaps in this tax management part of the year, to that message.
Economist Peter Schiff has shared some predictions for 2024. The big surprise in 2024 will not only be that the economy crashes into recession, but that high inflation returns with a vengeance, he described. The technicals are breaking down for the U.S. dollar index, he added, emphasizing, this couldn't come at a worse time. The Fed is planning interest rate cuts, which will not only accelerate the decline, but put renewed upward pressure upon inflation. If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.